So one of the things that's been in the news a lot is the recent valuations of, say, the S&P 500. Now, keep in mind that that's really skewed the valuations in the S&P 500 because, as we've stated many, many times in these videos, there's a large a concentration of a few companies that are making a large outsized proportion of that return and the valuation of all of these companies. It's very concentrated in a few names. But with that being said, one of the things I wanted to point out today, and we'll share the slide or the infographic up in your screen, is a discussion of the current valuations. We get the question all the time. The valuation of the S&P today, whether it's 23, 24 times earnings, is that expensive? Is that cheap? Should I be worried about what these stocks are trading at? And of course, the answer is we don't know any of that. But we can look at history and get some idea of kind of when we've been in these type of valuation situations before, where arguably stocks in the S&P, at least the S&P overall, is trading at a higher valuation. We can look at history and say, well, what has maybe the next 10 years, the following 10 years of a scenario like that look like? So, for example, if you look at the slide that we put up on the screen, the average valuation when this statistic was put out was about 23 times earnings is what the S&P is trading at. And it's certainly traded at a higher valuation in past, maybe 25, 30 times earnings. So does it have some more room to run? Maybe. There's also been times like '08 and '09 where maybe it traded at 8, 9, 10 times earnings, which people should have been buying like crazy, but people either didn't have the money to invest or were too scared to invest for understandable reasons at the time. But if you look at the chart, it would make sense. I think it makes common sense that the higher that companies trade at today, the lower their possible next 10-year return average might be. The cheaper that stocks trade at today, the lower the valuations. Makes sense that probably the next 10 years historically might provide a higher annualized return. And what does that mean for stocks and bonds? Well, at the market trading at 23 plus times earnings today, the average 10-year stock return, average, could be higher, could be lower, has been around 3.8% annualized the next 10 years. Now that's, again, if you're blindly investing in an index, there's certainly other asset classes, certain strategies that in that time period could have performed much better or much worse. But it's just a cautionary tale that the higher the earnings go on these valuations of the market, the riskier the market gets, the more due diligence that needs to be done and taken in portfolios, and more diversification is in order as those things develop. Now, what does that mean maybe on the bond side of things? Well, anytime, if you'll see in the red or pink dotted box on there, anytime that yields or bond rates have traded between, say, 4 and 6% interest, which is kind of where we're at today, the forward 10-year return of bonds, both interest and appreciation, has averaged over 5% annualized. So not a reason to panic and get out of the market, not a reason to put all your money in bonds. But bonds have really struggled over the last few years and really the last decade. So I think what this points out is something that we always talk about, is diversifying among different types of investments, asset classes, different sectors of the economy, not blindly investing in just one index.